Let's look at the different ways that accountants and economists look at costs and profits. First, let's look at the economist's view of costs. Now, economic costs, as we've said earlier in earlier videos, include all opportunity costs, and that is the things that you have to give up to gain the present product. We can split economic costs into those that we can measure, explicit costs, and these are the payments we make to the factors of production, land, labor, capital, etc., which you can actually measure. Whereas economists also know that there are some costs that you can't measure, and these have to be estimated, and they are effectively estimated payments that the resource could earn in its next best alternative employment. Now, one thing that's important for us to realize is that one of the implicit costs is what we call normal profits. And this is an implied return to the entrepreneur. It's the minimum payment that the entrepreneur has to gain to retain him in the present line of business. So the meaning of profit now depends upon us taking into account all these opportunity costs, because economists measure profit by taking the difference between total revenue and the opportunity cost of all inputs, whereas accountants take only explicit costs away from revenue to arrive at their measure of profit. Now you may ask, why do they make this distinction? Why do we make this distinction? Well, economists are interested essentially in resource allocation. They're interested in knowing what opportunity costs are incurred when we move resources from one use in the economy to another. You may recollect we talked about this when we were talking about the production possibilities frontier. Whereas accountants have a different focus. They're interested in measuring the current profitability of a business to report to shareholders, or in order to work out how much tax they own, or something like that. So their focus is mainly on explicit costs and not on implicit costs. So for the economist, economic profit is total revenue minus all opportunity costs, whereas for the accountant, profit just includes excludes explicit costs. Let's formulate an example. Let's imagine that I decide early in the morning, because I get up very early, that I'm going to use those early hours in the morning to bake some biscuits using an old family recipe, and I call them G's Bix. They're delicious. They're essentially homemade. That's one of their marketing benefits. I make them a crack at dawn for delivery to the office when I get to the office. Let's say, because I'm conscious of the health and safety regulations, I use my brother's oven. He has a registered baking business. I pay obviously for the ingredients. I use simple packaging, a cellophane bag with a label on it. And I have about 100 guaranteed customers a week. And I get $5 a packet for these biscuits. Let's have a look at the accounts for this business. First, let's look at from the point of view of an accountant. Well, the revenue, 100 packets at $5 is $500. That's pretty clear. It won't differ for the economist either. The explicit costs, okay, the ingredients, flour and sugar, etc., cost $100. Electricity for baking, I have to pay my brother a token $30 to use his ovens. Can't expect him to meet the electricity cost. Let's say printing and packaging, etc., cost me something like $15. So the explicit costs are $145 when we add them all up together. So that gives an accounting profit of $500 minus $145 is $355. Wow, that looks quite a lot of profit. So it would appear that the time I spend is bringing me something like $355. Okay, now what about the economist's view of these costs and profits? The picture isn't quite as rosy when we look at the economist's view. Same revenue, explicit costs the same as before, adding up the flour, etc. Exactly the same. But where there's a difference is in implicit costs. Now, an important implicit cost is the cost that I incur by baking these biscuits in terms of what I could do with the time, not only actually baking them, but also going off and purchasing all the ingredients and distributing the biscuits. So let's say I estimate that to be just my time as $100, worth $100. Now, because I'm involved in publishing or doing whatever I'm doing to earn that, furthering my career in the university, valued by me an implicit cost of $100, that means I have to employ a baker. So I have to pay him wages. Then there are purchasing and distribution costs. I have to rent space now to do the baking, and I can't expect my brother to allow some strange baker into his premises that early in the morning. And I'll have to lease a vehicle to do the distribution, etc., let's say. So the implicit costs because, sorry, just going back to the lease of the vehicle, I currently use my own vehicle, but if I'm not driving it, I have to lease one. So implicit cost in total will be $350 when we add up this column here. And if we add both explicit and implicit costs, we arrive at $495. Take that away from the revenue of $500, and we arrive at economic profits of $5. That looks much less attractive than the accountant's version of $355. Okay, let's put this in a little diagram. Total revenue is $500. It's the same for both economists and accountants. Accountants take into account the explicit costs, $145. If we take the 145 from 500, we arrive at that $355 of accounting profits that makes the business look pretty attractive. On the other hand, if we look at it from the economist's viewpoint, the explicit costs are equal to 145, just the same, flour, etc. If we add up all the implicit costs, we saw that we would arrive at $350 of implicit costs, which includes the normal profit. And adding both explicit, 145, to implicit, 350, we arrive at $495, which when taken away from the revenue gives us $5 of economic profit. So 145 plus 350 plus 5 uses up the whole of the $500 of total revenue. So, in summary, there is a difference in the interpretation of profits for accountants and economists. For the economists, all opportunity costs are included, which includes as well what we call the normal profit, which is an implicit cost to the business, implicit return to the entrepreneur. The accounting meaning of profits only includes explicit costs. Total revenue minus explicit costs only.